podcast. Good, good day. How are you doing? And I hope today you are doing great. We're here to study a new chapter today, and the name of the chapter is Accruals and Prepayment. I know you guys are just beginners, and maybe you have never heard about Accruals and Prepayment, but I believe that you have already encountered the accrual concept and the prepayment concept in your daily life. I firstly want to give you a general overview of what accrual is all about and what prepayment is all about. Accruals in accounting arises when you have not yet paid an expenses, but you have already incurred the benefit from the expenses. For example, your electricity bill. For the month of December, you have already enjoyed the electricity, but you have not yet paid the electricity, meaning that it's when January will come that you will pay the electricity, or maybe you don't even have money to even settle your electricity bill, and you're going to settle your electricity bill only in January. In this case, we refer it as accruals. Accruals are expenses that you've incurred but you have not yet paid. I believe that maybe you have already had an accruals in your daily life. If, for example, you go to the nearby shop and you take how can I say a an item and you have not yet paid that item. You have not yet paid the item. You have to pay it in the future. Though when you be designing your financial statement, you're going to take into account that expenditure, even though you have not yet paid, even though cash have not come out from your pocket, because that's an accruals. And prepayment arises when you pay expenses in advance whereas you have not yet incurred. For example, let us take the same example, electricity bill. In the year during the year, you have paid electricity in advance. Means that in January you have paid electricity for 15 months. Meaning that you have prepaid the one for January, February, and March of next year. In this case, we refer it as prepayment. Prepayment is an asset. Why is it an asset? Because it's like you have just transferred cash from the cash account to the prepayment account, and all those accounts are classified under asset in your balance sheet. I just wanted you to understand the accrual, the prepayment. I don't want you to be afraid. It is possible for you to really grab the concept because it is not difficult. You just have to be attentive to what I'm saying and do a lot of practice. Revise your Kaplan kit, and now we're going to go into the chapter. Right, give me some minute. Okay. Now we are having the accrual concept. The accrual concept, there is expenditure, there is income. Under the expenditure is accrued, is prepaid, and under the income is accrued and is prepaid. I've already told you the expenditure refers to electricity bill. The electricity bill, you can have accrued expenses and you can have prepaid expenses. As the example I've previously taken, the accrued expenses arises when you have enjoyed a benefit but you have not yet paid. Now, for prepaid benefits arises when you have paid for an expenditure, but you have not yet incurred the benefit of that expenditure. Like you have prepaid the electricity bill for the month of January, February, and March. Now, the income, the accrued income, this is income earned but not yet received. You see, then now the accrued income is an asset, whereas the accrued expenditure is a liability. Why is an accrued income an asset? An accrued income is an asset. Why? Because you have rendered services or you have transferred goods to a third party, but the person have not yet given you that money. The person have not yet settled its obligation. It's like you have transferred your inventory from the inventory account to the receivable account, but the person have not yet paid you. That is an accrued income. Means that you are eligible to that income, but you cannot define the income in terms of cash because you have not yet received the cash, but you have earned the income already. And since we are preparing our financial statement under the accrual concept, you have to take into account this transaction in your income statement. But at the same time, you are to do the contra entry by recognizing the transaction in your balance sheet as an asset. Prepaid income is a liability, whereas prepaid expenditure is an asset. Why is prepaid income a liability? Prepaid income arises when a customer pays us in advance, whereas goods have not yet been transferred. IFRS 15 state what? That you can only recognize an income once good has been transferred, once right over the asset has been transferred to another third party. This is when you have the right to recognize a revenue. But once the ownership have not yet been transferred, you don't have the right to recognize a revenue. In this case, for example, you need my services. Like you need my services, and I have an online university. I'm providing ACCA courses. Then you come in my university, then you pay in advance for 3 courses for FA, MA, and BA. Then now we are studying FA. You're still to study MA and BA, BT Technology. But now in my account, in my books, I will recognize the FA rate income because actually I'm already transferring the knowledge to you. You're already enjoying that services, but you have not yet enjoyed the MA services classes. You have not yet enjoyed the BT services classes. Now I cannot recognize the BT and the MA because I have not yet delivered the services to you. And the BT and the MA will be recorded in my books as a liability because I am owing you. You have given me your money, but I've not yet rendered the services to you. I cannot recognize that income. I cannot recognize it because it is not my own yet. I have not yet transferred that. I have not yet fulfilled that obligation. That is what I want you to understand. You need to understand that an accrued income, are you getting me? I want you to understand that an accrued income is an asset. An accrued expenditure is a liability. Do you understand? It means that an accrued income will increase your profit. An accrued expenditure will reduce your profit. You need to understand the relationship between those two. An accrued income will increase your profit. Why will it increase your profit? Because that money you have already earned, but you have not yet received it in the cash form. meaning that it increases your profit. An accrued expenditure reduces your profit because you have already enjoyed the benefit of that expenditure, but you have not yet settled that obligation. A prepaid expenditure is an asset because you have not yet incurred that expenditure, but you have already paid for the expenditure. You see, it is an asset, whereas a prepaid income is a liability. Why is a prepaid income a liability? Because you have not yet delivered that services to the third party. You have not yet transferred ownership of the asset to the third party. The asset is still in your premises. The date of the transfer have not yet reached. You cannot recognize it in your books. Then now they say the introduction. This chapter consider the accrual basis of accounting. That was actually then you're going to read this one. Then the accrual basis of accounting. You see, here they're telling you that the accrual basis of accounting means that to calculate the profit for the period, we must include all the income. That's what I was telling you. We are using the accrual basis, the accrual concept to prepare our financial statement. Maybe you might ask yourself, why are we using the accrual concept? We are using the accrual concept because it is not all the expenditure that we incur that we have settled. It is not all the income that we have earned that cash has been received. Remember, remember, it is not all. That is why we have this concept. We use this concept to design our financial statement. It is very important. This concept is very important because can financial statement are being drafted, are being prepared using the accrual concept. And you know already it's true that you're still beginner and we're going to in the future lesson we're going to do our income preparation financial statement and you're going to understand a lot of stuff, but for now you need to understand this concept because this concept will help us in the preparation of financial statement, because ACCA is a very interesting field. It's a very interesting accounting program, and an adjustment will be given to us. We need to adjust our info, the various elements in the trial balance, and amongst those adjustments, we will have accrual adjustment. That's why you need to understand this concept. It is very, very, very vital for a good preparation of your financial statement. Now we have the accrual concept. As I've made you to understand, you need to understand. You don't need to, how can I say, cram the ACCA theory. You need to understand it. You need to be able to develop the skill to explain what accrual concept all is all about. Do you understand? You already know that the accrual concept arises in situation. You see, wait, I've already, let us go through a bit what ACC is telling us. You see, they are saying that conceptual framework explain accrual accounting as depicting the effect of transaction and other events and circumstances on a reporting entity economy resources and claim in the accounting period in which those effects occur. This will be the case even if cash receipt and payment arises in different reporting periods. The accrual concept is identified as an important accounting concept by IX. 1. Presentation of financial statement as it provide a better basis for assessing financial performance rather than relying solely upon information relating to cash receipt and payment. Therefore, all of the expenses involved in making the sales of for a period should be matched with the sales income and dealt with in the period in which the sales themselves are accounted for. Do you understand? Why is the accrual concept existing? The financial statement in one of their statement known as their statement of profit and the statement of profit and loss is that it takes into account all the expenditure incurred during the year, all the expenditure that was incurred in order to generate the income, in order to generate the sales revenue. Do you understand? And if we don't use the correct concept, there are a lot of expenditure that we're not going to take into account. A lot. Because company, it is very rare to see a company that will always settle all their obligation. It is very rare. It is very rare. And that is why this concept comes in to improve financial statement preparation. That is why, no, despite the fact, irrespective of if payment was made or not, you have to recognize it in your financial statement. You have to recognize it in your income statement. You see, you have to recognize in your income statement in order for you not to mislead the shareholder by providing wrong information. That is what the accrual concept exists. The accrual concept exists because all expenditure must be taken into account, irrespective of if it was paid or not. All income must be taken into account, irrespective of if money was received or not. That is all about the accrual concept. That is why this explanation, this theory, is just to make you to understand that the accrual concept comes in, comes in order for financial statement preparer to take into account all expenditure they have incurred without paying them and all income they have earned without receiving the cash. Then now they're saying that the sales revenue for an accounting period is included in the financial statement in the statement of profit and loss when the sales are made. This means that when a sales is made on credit, it is recognized when the agreement is made and the invoice is sent to the customer rather than waiting until the cash for the sales is received. This is done by setting up a receivable in the statement of financial position for the amount of cash that is due from this debit receivable and credit sales revenue. We have previously we have previously completed the double entry principle. You really understand that when you sell goods on credit, you see, you sell goods on credit. This is income that you have not yet earned. If the customer have not given you any money, you have not yet earned the income. You have not yet earned the income, but you have realized the sale during the accounting period. And if you realize the sale during the accounting period, it is normal for you to take into account that sales. That is why you need to recognize that sales in your book. It is an obligation. You must recognize it in your book because if you don't recognize it in your book, you are presenting, you are presenting, you are misleading you are misleading the shareholders by providing wrong information in your financial statement. That is why the sales revenue, it is based on the accrual concept and not the cash basis. Do you know the cash basis in accounts is like you are taking into account only transaction that are related to cash. You're ignoring whatsoever. It's not linked to cash. That is why we have the cash flow statement. We are coming to that in the when you be doing financial statement preparation. You're going to know what is the cash flow method, the direct and the indirect method. The cash flow method come in to solve resolve the differences between the profit figure and the cash because many people don't understand. Many students believe that the profit is the cash. The profit cannot be the cash in your balance sheet. Why? Because the profit have a lot of non-cash item. Do you understand? Like pre the Accrual, this is just an example. This is a non-cash item because no cash transaction has occurred. You're just recognizing an obligation because you have not yet paid for it. But at the end of the day, as you see the recording, there's no cash. For the sales revenue, when I sell it to the third party, he has not yet paid me. Do you understand? He has not yet given me any cash. He has not yet given me any dime. But I need to recognize it in my book because why? I've earned the income. That's accrued income. I've earned it. But I've not yet received the money. Because I've not yet received the money, I need to recognize it in my books. You see, that's why I will debit what my receivables and I will credit what my sales revenue. You understand? I debit my receivable, I credit my sales revenue. I recognize my income at the same time I recognize an asset. Once now the receivable is going to settle his outstanding bill, then I will reverse the entry. I will record at fresh by debiting the cash now. I removed the receivable from my books because the receivable have already settled their obligation. Then I will debit my cash. I will credit what my receivables. That's what I want you to understand. Then we have purchases. They say similarly purchases are matched to the period in which they were made by the accounting for all credit purchases when they took place and setting up a payable in the statement of financial position for an amount due. Do you understand? Purchases is like you already know purchases because you have done double entry principles and preparation of ledger account day books. Purchases is all like this transaction that you undertake in order to buy goods and services that you're going to sell at the end of the day to your customer. And then purchases can be that is why the purchase value. is always adjusted in the cost of sales because it is not all the good that you purchase that you sell. In some circumstances, the good that you purchase you can sell it all, but it's not all. That is why you will have cost of sales in our income statement. The cost of sales is what opening inventory plus purchases minus closing inventory. Yeah, we can also have minus return award. Any good that we have purchased that was defected and that we have returned it to the suppliers. We can have also we add also transportation costs. If we have incurred any transportation fees in order for the inventory to come into our warehouse, we need to incorporate it in the value of the inventory. Do you understand? I hope you still remember the last lesson. Then we have cost of sales. And the major cost involved in making sales in a period is the actual cost of the goods that are being sold. Do you understand? As we saw in a previous chapter, we need to adjust for opening and closing inventory to ensure that the sales made in the period are matched with the actual cost of those goods. Any good unsold are carried forward to the next period so that they are accounted for when they are actually sold. Do you understand? Wait, I have a graph here. Now I want you to understand we have done the inventory valuation method, but this one for simplicity I've just considered that the opening inventory have the same unit price as the purchase invent as the unit price for purchases, just for us to easily calculate. Now what are they saying at this level? They are saying at this level that it's not all the good that you have purchased that you record in your income statement. And firstly, I want you to pause the screen and do this thing. I want you to determine what is the cost of sales. Pause the screen because we have already gone through this inventory valuation, and I believe that you are already well equipped to determine what is cost of sale. And I want you to pause the screen and do these exercises. Then I'll be solving it, and once you through, you you follow back the lessons where you have stopped in order to see how I'm solving it. Accounting is all about practice. The more you practice, the more you become a guru, an accounting guru. Means that you need to practice a lot. Then on the cost of sales, the major cost, as I've read already. Now, what is it like? What is this paragraph all about? The paragraph wants you to understand that it is not all the good that you purchase. You see, it's not all the good that you purchase that will go into your cost of sales value. That is why the cost of sale is a formula for it. Means that in this one we have 1 month company in record, we have quantity unit price total, we have opening inventory, and we have purchases. Then the question is that it sold 600 units of goods at a price of $300 each. Then now this will be an extract of the income statement. Do you see my cost of sales value? My cost of sales value is 60,000. Now, the 60,000 is the value that will go into your income statement. That is why it is not all what was purchased that will go to your income statement, but it's only those value. It is only that quantity that you have sold that will go into your income statement. That's the matching principle. We're coming to that. Means that it is just those goods that you have sold that are going into your income statement. Meaning that you purchase 80 800 units. You had an opening inventory of 300 units, but you only sold 600 units. Meaning that it will be wrong for you to consider 30,000 and 80,000 as cost of sale. You need to derive the closing inventory value, and then now you deduct it from opening inventory plus purchase inventory to arrive your cost of sale. That is what this paragraph all meant about. I hope you've understood it. Then we can go back to the lesson again. Then we have expenses. The expenses of the period that the business has incurred in making its sales, such as rent, electricity, and telephone, must also be matched with the sales for the period. Yeah, it's right. They're right. Electricity, rent, they must be matched with the sales for the period. That is, you cannot consider the rent of last accounting period and record it in this accounting period. You cannot consider the rent for future accounting period and record it in this accounting period. You must apply the matching principle. You must recognize the rent that you have incurred during this accounting period. That is what you must do. You must not do something contrary to that. That would be misrepresentation of financial information in your financial statement. Then now we have accrued expenditure. An accruals arises when expenses of the business relating to the year have not been paid by the year end. This will reduce profit for the year. In this case, it is necessary to record the extra expenses relevant to the year and create a corresponding statement of financial position liability called an accruals. Do you see? As I was saying previously, accrual is when you have incurred already the benefit, you have incurred an expenditure. You've already enjoyed the benefit of that expenditure, but you have not yet paid. If I have not yet given you money, I have an obligation toward you. And you know that an obligation, it will be recorded as a liability in our financial statement. You see, that is why we debit what? We debit an expenses account and we created the accruals account to recognize the obligation. It is very important that you remember that an accrued expenses is a liability. Do you understand? Then we have the illustration. Then the illustration, I think you can do it alone. I believe you can do it alone. It is quite very simplistic. And I want you to go to do the illustration alone. We are going to go to this understanding. We're going to go to this understanding. Okay. Now the test understanding, we are going to at the same time revise our double entry principle. Do you understand? Because the double entry principle is a key. Do you understand? I hope you understand. Now, after your understanding, I want you, all of you, to be concentrated. If you can pause your screen and do it on your own, that would be good. Because as I told you, account is all about practice. The more you practice, the better you become, and the more brilliant you are. And now you'll be an ACCA an expert, an ACCA expert, an ACCA guru in financial accounting. It is possible for you to be the first in the whole world in as far as financial accounting is concerned by scoring with 96%. I had 91% in financial accounting. It's a very interesting course. It is not difficult. I really, really tell you, it is not difficult. You need to focus. You need to follow all the lessons. You need to practice and practice and practice and practice. You need not to be discouraged. ACC is not meant just for a category of people. Everybody can succeed. Even you can succeed. Don't give up. Don't give up. And never you tell yourself it is impossible. Okay, let us do. Let's your understanding one. Direct business has an accounting year end of 31st December 2001. Direct rents factory space at a rental cost of 5,000 per quarter. Payable in arrears. Do you know what it means by payable in arrears? Payables in arrears is when you enjoy the benefit of the expenditure but you've not yet paid, and you're paying it at the end of the quarter. They have made a small table here. We have quarter period. I hope you know what it means like quarter. Quarter means every month. Since in a year we have 12 months, quarter means every month. We have January, February, March for the first quarter. The payment, the equation said the payment is on the 31st of March. What is the payment? The payment is 5,000. Okay. Then we have April, May, June. The payment is on the 29th of June. The payment value is 5,000. You have July, August, September. The 2nd of October, the payment value is 5,000. Then the last one, October, November, December. The payment value, it is being paid on the, it will be paid on the 4th of Jan, on the 5th of January, and the value is 5,000. Now we are going to do our double entry. We are going to revise our double entry. Why doing this exercise? I want you to pause the screen and do the double entry. Whosoever have not paused the screen earlier, because the double entry is what we have done already. I want you to do the double entry of this transaction, of this four transaction here. The first one is like 31st of March when payment is being made. Whenever you pay, you have a two account. You know double entry. We have the expenses account. We have the cash account. Then now when you pay, you debit your expenses account because expenses increases on what, on the debit side. You debit your expenses account, then you credit your cash account. Asset account reduces on where, on the credit side. Why you crediting your cash account? Because money is leaving your entity. You are settling your bills. The second transaction, 29th of June 2000, 29th of June, we have the cash, and the year 29 we have a rent, 5,000, double entry principal, debit credit, debit credit. 2nd of October we have the 5,000, then we have again the rent, 5,000. You have fulfilled, we have respected our double entry principle. Then now on the 31st of December we have an accruals. Why do we have an accrual? Because we have enjoyed the benefit of that quarter. Remember that the quarter is October, November, December, and October, November, December is part of our accounting period. October, November, December is part of our accounting period. That is why we take into account that expenditure in this financial year. That's why you're going to see that we debit our expenditure, our expenses account, and instead of crediting cash, you will say we credit cash. No, 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 no. You cannot credit cash. You cannot credit cash because money have not left your entity. Money have not left your entity. You have not yet paid. You have to pay on the 4th of June. On the 4th of January. It will be only on the 4th of January. You understand? It will be only on the 4th of January that you're going to recognize this transaction by crediting your cash. Not that you're going to recognize, sorry, but that you're going to fulfill that you're going to fulfill the financial obligation by crediting cash. But in this case, you're already recognizing in your book because you've enjoyed the benefit of that expenditure already. Remember, October, November, December is part of the accounting period, and you need to take it into account. That is why it is credited in the accrual account by 5,000. You have fulfilled your double entry. Now the expenses account need to close it. You are sending all the expenses to the account in the profit and loss. That's why you credit your profit and loss 20,000, and you will report it into your profit and loss. That is expenses rent 20,000. The cash account you will not you can close the cash account if there's an opening balance. For sure there are other transactions. Then you derive your closing balance. Your closing balance is what is to go into your balance sheet. then then the accrual account you will close it to. If there are other transactions, there might be an opening value, there might be an other transaction that will give rise to an accrue expenses. That is why the other account have not closed it, but for the expenses account you can see I've closed it already. You see, and you need to understand, as I've previously said, accrual reduce profit and increase liability. I hope you understood this part of the lesson, and I hope to see you soon. No, see you soon for the next lesson. And don't forget to revise, practice, and practice, and practice again. It is possible. Always practice. It is possible for you to score 96% in FA this session. Thank you.